Yeah, welcome everyone, and thanks to Mark for introducing me, and thanks to the organizers, of course, for including this paper into the program. It's a great honor for me to be here, and it's amazing to be in Salt Lake City to be able to attend a conference. This is joint work with Ye Li, who is from Ohio State University, who unfortunately is not here today. From 2008 onwards, the rise of cryptocurrencies, and in particular Bitcoin, heralded a new era of digital payments. However, the inherently high price volatility of cryptocurrencies limits their function as a means of payment. A more recent phenomenon related to blockchain technology and cryptocurrencies is the rise of decentralized finance. As the name already suggests, decentralized finance is finance without an intermediary and offers blockchain-based alternatives to banking, lending, brokerage, exchanges, and so on. Crucially, most of these decentralized finance activities demand a blockchain-based safe asset that can function as a means of payment. Stablecoins meet this demand. The upper two panels of this graph give you an idea about the recent growth of the decentralized finance sector. The left panel depicts a measure of decentralized lending activity, and the right panel depicts a measure of decentralized exchange usage, both of which are integral parts within the decentralized finance ecosystem. More interestingly, simultaneous to the expansion of the decentralized finance sector, we have also observed that stablecoins have grown in value at similar pace. By today, stablecoins have reached an aggregate market cap of more than 175 billion US dollars. The trend indicates further growth. So what are these stablecoins? Stablecoins are cryptocurrencies that are designed to minimize price volatility and that are typically pegged to a reference unit, which most of the time is the US dollar. Most stablecoins are issued by specialized stablecoin providers, which do not conduct any other businesses, such as MakerDAO or Tether. And these can be decentralized organizations or some centrally held organizations. Interestingly, in addition to that, we have also well-established networks or payment providers which venture into the stablecoin issuance as well. An example of that is JP Morgan with its JP Morgan coin, or more recently PayPal, which also announced that it plans to launch its own stablecoin. So the crucial question is here, how do these stablecoins maintain price stability and the peg to the US dollar? The most successful and least volatile stablecoins rely predominantly on reserves or collateral backing their stablecoin, which allows for open market operations to stabilize the price. For instance, when the price of the stablecoin falls below the peg, the issuer can use its reserves to buy back stablecoins and to drive up the price again back to the peg. Most of the times, or almost all times, these reserves are risky assets. So I get very often this question when I present this paper, is stablecoin issuance just narrow banking? In most cases, it is not. It is far from that. The stablecoin issuer transforms highly volatile assets into safe assets. For instance, Tether, the largest stablecoin, is to a large extent backed by commercial papers of unknown quality and by other highly volatile assets, including crypto assets, and only to a minor extent backed by cash or cash equivalent. In addition to that, we also have so-called algorithmic stablecoins, which I want to touch on quickly. They claim to employ some alternative or innovative stability mechanisms, but most of the time, these algorithmic stablecoins turn out to use just less reserves or riskier reserves, and they are not so much different to the reserve-backed counterparts. We have also witnessed some drastic failures in this space, which renders questions whether this is a viable approach. So given the growing importance of these stablecoins, we as financial economists need a model that helps us understand stablecoins, in particular that helps us assess the viability, the fragility, and the stability of certain stablecoins initiatives, and especially when we want to talk about regulation. In this paper, we provide such a framework. With our model, we also rationalize many of the strategies that stablecoin issuers employ in practice, and moreover, we provide guidance for optimal implementation. These strategies include, but are not limited to, open market operations, the requirement of user collateral to back their holdings, transaction fees, a price band within which the stablecoin price can float, or the issuance of so-called governance tokens that function as the stablecoin issuer's equity units. In this context, our framework can also be used to value these governance tokens behind many stablecoin initiatives, which is what practitioners actually are interested in. We put particular emphasis also to study the stablecoin initiatives led by large platforms or payment providers such as PayPal. In this context, we consider that the stablecoin issuer collects and utilizes the transaction data from stablecoin usage, and we ask whether this is a good thing, or whether one should preclude such data collection through privacy requirements. And finally, we use our framework to derive some implications for the regulation of stablecoins, thereby contributing to ongoing policy debates. So let me give a quick overview of our framework. We consider a dynamic model in which stablecoins are issued by a risk-neutral stablecoin issuer, which we call the platform. However, the platform is financially constrained in that raising financing by issuing new equity is costly or not even possible. Stablecoins offer a convenience yield and are therefore bought by the users. These users are risk-averse, which reflects that they value price stability, or simply the fact that price stability is a desirable feature of any transaction medium. The platform maximizes its equity value. In order to do so, it dynamically controls its reserve assets, the transaction fee, and the stablecoin supply, possibly via open market operation and trading against the users. In this context, we demonstrate that the platform strategies are fully characterized by one state variable, the platform's excess reserves C. The platform's excess reserves C are defined as the difference between the reserve assets and the total value of stablecoins outstanding in US dollars, our numeraire. In particular, when the excess reserves are large, the stablecoin undergoes a virtuous cycle. Under these circumstances, there is no price volatility, low transaction fees, and the stablecoin price is indeed at its peak. All of these features stimulate the demand for the stablecoins and the revenues of the stablecoin issuer, which further grows the stablecoin issuer's reserves and improves stability and so on. By contrast, when the excess reserves are low, because there were shocks to the issuer's reserves, then there is a vicious cycle. Under these circumstances, we have high transaction fees, high price volatility, and the stablecoin price falls below its peg. This limits the demand for the stablecoins and the revenues of the stablecoin issuer, further exerting downward pressure on the issuer's reserves and exacerbating instability. As a result, we obtain an instability trap. Stability lasts for most of the time. However, once the stablecoin becomes unstable and price volatility spikes, the recovery back to the stability regime is slow. The growing importance of stablecoins has clearly attracted now interest from policymakers and regulators. To give two examples of that, on the 1st of November 2021, the US Treasury released a report on stablecoins, also outlining potential regulation. After that, on the 14th of December 2021, the US Senate held a hearing about the risks and benefits of decentralized finance and stablecoins. We would like to contribute to this policy debate and use our model to derive some suggestions for optimal regulation. We find that a capital or reserve requirement for the stablecoin issuer is beneficial in that it leads to more stability and less fragility. One might say this is an obvious thing because a stablecoin issuer looks like a bank. But in this context, we can also use our model to assess under what circumstances capital requirement should be stricter. And we find that in particular, if the stablecoin issuer is a large payment provider or conducts any other business next to stablecoin issuance, then it is optimal to impose a stricter capital requirement. Interestingly, restricting the riskiness of the stablecoin issuer's reserves has the opposite effect than a capital requirement. We find a volatility paradox. If the regulator restricts the riskiness of the reserve assets, the issuer endogenously reduces the reserve assets she holds, and which can actually exacerbate instability. And finally, we find that a privacy requirement that restricts the stablecoin issuer from collecting transaction data has the unintended benefit of also stabilizing the stablecoin. At this point, let me go into the model, skipping the literature review, which is in more detail in the paper. The model is cast in continuous time, and there's an infinite horizon. There's a continuum of users indexed by I who buy tokens and discount the future at the interest rate R. Tokens, which I use as a synonym for stable coins in this paper, have an endogenous price which has the dynamics in 1. The price has an endogenous drift, μp, and an endogenous volatility, sigma p, which will be determined in equilibrium. And here dz is a Brownian shock to the issuer's reserves, which we will discuss later in more detail. Notice that the stablecoin is stable when there's no volatility and sigma p is 0. When sigma p rises above 0, then we have price volatility, and actually there's some fluctuations around some peg. The users can trade these tokens without friction in a secondary market, both among themselves or possibly against the platform who conducts open market operations. In particular, the platform controls the nominal token supply, denoted ST, and for instance can issue new tokens, in which case the supply expands, or buy back tokens, in which case the supply contracts. So now, why are stablecoins used in our model? Why do users hold them? Well, we assume a convenience yield. And to formalize this, we denote by UIT the dollar value of a representative user's token holdings at time t. And if this user holds UIT dollars in tokens, she derives an instantaneous payoff, like a per period payoff essentially, in this line. And this payoff consists of a convenience yield to holding these stablecoins, which could capture that you can use it as a transaction medium, that you can use it within DeFi, that you can lend it out, also on. We don't take a stance on that. But this payoff also increases with potential price appreciation and decreases with the opportunity cost of holding the stablecoin, the interest R, some fees the platform levies to its users, and with some disutility of being exposed to stablecoin price volatility if there is any. So this utility simply captures that users are risk averse and they value price stability. And we also introduce some other features like network effects, namely that the convenience yield any individual user derives from holding these stablecoins depends on the volume of other stablecoins held by other users, and that's here simply the aggregate token holdings of users NT. Without going too much into detail, the users solve. Okay, so now this is like, okay. Oh, I see. Okay, thanks for. So without going too much into detail, the users optimize over their token holdings, and that leads then to some endogenous stablecoin demand in equation 4. And this stablecoin demand, yes, there's nothing which is super important except that this stablecoin demand decreases with price volatility, again reflecting that these users value the price stability. And we, for technical purpose, we impose an upper bound, but this is not relevant for the sake of this presentation. So let me now discuss what the platform does. The platform, as I said, manages this token supply and holds some reserve assets empty against the stable coin. And the platform's reserve evolve according to the dynamics in 5 and grow with the interest earnings on the reserves. They grow with the proceeds from issuing new tokens, and this term is negative if the platform buys back tokens. They grow with the fee revenues the platform collects from the users. And lastly, the platform's reserves fall with dividend payouts to its platform owners and are exposed to some shock. And this shock can also be interpreted broadly. It can capture operational losses, but also more obviously can capture that the reserve assets are risky. And here, this is just some source of uncertainty. What does the platform do? The platform maximizes the equity value of its owners, which is the expected discounted value of future dividend payouts, DDIV. And these dividend payouts must be positive, reflecting that the platform owners are protected by limited liability and that it is not possible to raise new financing by issuing equity. We relax this assumption later on and find that the results remain unchanged, as long as there's some cost to issuing equity. There's another technical assumption, which is simply that the owners must be more impatient than the users so that they do not indefinitely delay their payouts. But this is more on the technical side. So let me describe what happens in equilibrium. In equilibrium, the market, first of all, has to clear. What does that mean? Stablecoin demand in dollars, NT, must equal stablecoin supply in dollars, which is the nominal supply ST, times the price PT. That has to hold at any point in time. So what state variables do we have to solve this? Well, we have the platform assets, MT, and we have essentially the platform liabilities. We can interpret it like that. That's the stablecoins outstanding ST times PT in dollars. And we now define the platform excess reserves, which is the platform reserve assets minus the value of outstanding stablecoins. Why do we do this? Well, first of all, we solve for an equilibrium where all equilibrium quantities can be characterized as a function of C. That means this platform excess reserves fully characterize the platform's optimized strategy, but also characterizes the stability of the stablecoin or the price of the stablecoin. In particular, the C has a nice interpretation. When C is positive, we have overcollateralization. Reserve assets exceed the amount of stablecoins outstanding. Under these circumstances, even if all users decided to sell their stablecoin holdings, the platform has sufficient reserves to withstand the selling pressure and to support the price level we have. In other words, there cannot be a run under overcollateralization. This changes under undercollateralization. Under these circumstances, there could be a run. All users sell their stablecoin and therefore would drive down the price south. This is not only a theoretical possibility. Like this is a bit similar to a bank run, but we have experienced such a run of undercollateralized stablecoins in June in 2021 in the so-called Iron Finance bank run, which has led to the collapse of the stablecoin issued by Iron Finance, a stablecoin provider. In this paper, we focus on overcollateralization. That is, we impose that the issuer of the stablecoin would always like to maintain a positive collateralization level. Why do we do that? Well, first of all, we have seen drastic failures of these undercollateralized stablecoins, the example of Iron Finance. And this suggests that likely in the future, regulators will impose that stablecoin providers have to be over-collateralized. At the same time, there are other papers out in the literature that study under-collateralized stablecoins in more detail, and we differentiate ourselves. In this context, there's an excellent paper by Routledge and Sidney Jones, who study speculative attacks for under-collateralized stablecoins. The results are similar when we also allow for under-collateralization, so this is like an assumption we could also relax. The key thing is now that in the fear that the reserves are depleted, the platform essentially becomes risk-averse and thus mind the volatility of its reserve assets. Finally, the last solution step is we have to calculate the law of motion or the dynamics of these excess reserves, which are given in 8. And the platform now maximizes its equity value subject to these dynamics, subject to the requirement that dividend payouts must be positive, subject to maintaining positive excess reserves, and in order to do so, it has 3 control variables. It can set the fees it charges to its users, which pins down the demand for stablecoins. Second, it decides when to pay out dividends, and it turns out that the platform simply pays out dividends once it has accumulated enough slack and there is a dividend payout threshold reached. And third, most interestingly and most importantly, the platform controls the token supply via open market operations. And mathematically, this can be fully characterized by the choice of sigma p, the price volatility of the token price, or the price volatility of the stable coin. If the platform sets now sigma p if the platform lets now the token price float and volatility rises above 0, the platform essentially shares risk with its users. It reduces its exposure to this cash flow shock, but this is costly because the users are risk averse. They mind actually price volatility. So what is the outcome in this case? We have 2 regions. We have a stability region and we have an instability region. When the platform reserves are sufficiently high, and in particular lie above some threshold, the platform maintains the peg. And the platform make sure that there is no price volatility. So the stablecoin indeed is stable. However, when there were sufficient negative shocks to the issuer's reserves that drive down C below a certain critical threshold, the platform lets the token price float. So we don't have a fixed exchange rate regime anymore, and there is price volatility. The following graph essentially depicts this outcome. The stablecoin is stable when the issuer's reserves are sufficiently large. However, once the reserves are depleted, volatility spikes. And this token price volatility decreases with the platform's level of reserves. As I said, users do not like when the stablecoin floats around and is not stable anymore. As a result, the usage or the demand for the stablecoin increases with the issuer's reserves. And in addition, we have that the fees the issuer optimally levies to the users decrease with the issuer's reserves. And in fact, they can even turn negative, which means that under certain circumstances, the stablecoin holders are paid interest rates, which is also what is observed in certain designs in practice. So the last panel, or the next panel depicts now the dollar value of tokens. On the left side, we have seen this. This is increasing because it equals the demand. The middle panel is essentially the token price. And we see the platform maintains a fixed exchange rate regime when C lies to the right of the dashed red line and is sufficiently large. However, once we enter the stability, once C falls below the dashed red line, there is no more fixed exchange rate regime. Essentially, the platform lets the price float, and price volatility emerges as a consequence of that. One can interpret this outcome as a targeted price band. In good times, the platform maintains a fixed exchange rate regime. In bad times, the platform lets the exchange rate float, a floating regime. How does it look with open market operations? When does the platform buy back tokens? When does the platform issue tokens? Our model predicts in this context, when the reserves are sufficiently high, then there's not much scope for open market operations. In the extreme case, no open market operations. It becomes more interesting for lower level of platform collateralization. When the platform reserves are at intermediate levels, a negative shock exerts some downward pressure on the token price. However, the platform under these circumstances withstands this negative shock and buys back tokens to push up the price again to the peg. Under these circumstances, open market operations stabilize the token price. However, when the platform fully runs out of its reserves, it acts the opposite. In response to a negative shock, it actually issues more tokens in the hope of being able to replenish its reserves. In particular, let me quickly show this nice simulation of states. This is nothing formal, but it already indicates what's going on. We look at panel B, which is the token price along a simulated path. As you can see, stability lasts for a very long time. Nothing happens. The price doesn't float. But at one time, suddenly price volatility kicks in, and the price falls below the peg of $1. Under these circumstances, this instability regime becomes quite persistent. It takes a very long time for the platform to recover back to the fixed exchange rate. We formalize this. In particular, we find a so-called instability trap. Stability lasts for a very long time without any hint of instability, but once, after sufficiently negative outcomes, debasement of the price occurs and volatility rise, we are trapped in instability. And under these circumstances, recovery back to the fixed exchange rate regime and to the stability regime is slow. As a result, we have a large probability mass in the stationary distribution of the excess reserves near zero, where there's high price volatility, and near the payout boundary, where there's no price volatility. Finally, I would like to talk about regulation. Regulation, we consider several different regulatory proposals. The first one, clearly motivated by the banking literature, is simply a capital requirement. And we simply model this by stipulating that the issuer's reserves or excess reserves must exceed a certain capital requirement, CL. Otherwise, there's some penalty or liquidation. This is standard from, as I said, banking. And what we find is essentially clearly such a capital requirement hurts the issuer because it imposes regulatory cost. So the issuer's value, the platform value, decreases with the strictness of this capital requirement. On the other hand, the users benefit from such a capital requirement because this capital requirement removes some of the instability of the stablecoin, which is what users dislike. And in fact, we find actually a capital requirement, if well designed, can lead to a total welfare improvement in that there's a unique maximum of a capital requirement, which would be the optimal capital requirement. And one could then construct some Pareto improvement, maybe via fees or like some other taxes. However, different to a capital requirement, restricting the riskiness of the issuer's reserves has the opposite effect. It can actually destabilize token price, giving rise to a volatility paradox. How do we show this? We consider an extension in which the platform issuer's reserves have an additional term. Here's a term that captures some risk-return trade-off. The platform issuer's reserves own some return at rate mu hat and are exposed to additional volatility at level sigma hat. We consider that mu hat is simply a constant times sigma hat, meaning that the Sharpe ratio of this investment is in some sense constant. What do we do? The dotted red line considers omega equals 0. So an increase in sigma hat just makes the whole thing more risky. What do we find? Well, we have like two measures of price stability. One measure is how often does actually the stablecoin maintain its peg? The second is what is the average price volatility? Average price volatility decreases with the level of risk sigma hat, while the probability of maintaining the peg increases with the volatility sigma hat. This means that actually when the issuer's reserves become less risky, then the stablecoin can actually become more risky. Why is that? Well, the issuer having less risky reserves becomes a bit bold and maintains less buffer, and this can then lead to more severe crisis or instability regimes. At this point, let me conclude. In this paper, we develop a dynamic model of stablecoins and crypto shadow banking. We find that despite overcollateralization, there can be fragility, and we characterize an instability trap. Stability persists for most of the time, but once stablecoins break the buck, they become very unstable, highly volatile, and may not recover back to its old stability regime. We rationalize many of the stability mechanisms we observe in practice. For instance, we consider that the stablecoin issuer requires users to put collateral to back their stablecoin holdings, which is in the paper, not discussed here. We discuss the dynamic management of platform reserves, of fees, and in particular also the issuance of governance tokens that function as the issuer's equity units. In this context, our model also helps practitioners how to evaluate such governance tokens. And finally, we contribute to the ongoing policy debate on the regulation of stablecoins. We recommend a capital requirement. However, we do not recommend a blank restriction on the riskiness of reserves. And finally, also not shown in this presentation, we show that if one regulates the stablecoin issuer not to utilize and collect transaction data brought up by stablecoin usage, the stablecoin becomes actually more stable, which is good. Thank you so much for paying attention, and I'm looking forward to many good questions and to a good discussion.